Coming up today, tech stocks close higher as fear grips the crypto market, mainstream media gets bearish, big data coming next week, the latest moves from billionaires, and will the McRib really save us, or is it different this time? Things are getting spicy out there, guys. Let's go. And welcome back, guys, on the last trading day of this week. Bit of a soft finish across the board. Did see a little bit of a bump up in tech, energy and biotech names. But once again, another sell-off across crypto. Accelerating lower today, as many traders have been liquidated and fear is gripping the market. So we're going to take a look at that, a few more things, and stick with me because we're also just starting to get some Form 13Fs for major hedge funds. So I'll show you later on the exact moves billionaire investors are making in their portfolios and exactly what stocks they are buying and selling, including a big one from Warren Buffett, potentially his last big buy before he retires at the end of this year. But for the here and now, even though the S&P 500 is not all that far off all-time highs, there's a lot more going on underneath the hood, including elevated fear and pessimism, especially in high beta growth stocks, including cryptos as well. The overall fear and greed index still in the extreme fear zone. And so far for the month of November, it's actually been the worst performing November in over 15 years. We have to go back to 2008, as it's normally a bullish month, but there is widespread pessimism all across financial social media. Just sharing a few posts with you guys today to give you a taste of what's going on out there. This guy here showing a picture of a monkey calling his mum saying, "My room's still available. Fourth quarter bull run is cancelled." Another guy posting, realizing you missed out on the top again and are stuck in this hellscape for another 3.5 years. This guy posting, "We are in a bear market," with crypto influencers saying the whole thing is collapsing. And this guy posting a photo saying he finally bought his first car thanks to the crypto bull run of 2025. We've even got Indian self-help gurus posting about crypto and stay away, you don't need the anxiety. And not hard to see why, as the sell-off accelerated today. Bitcoin down at $95,000 a coin, with Ethereum actually holding up a bit better, fending recent low at $3,000 a coin. But looking at the closely related meme stock ETF, we did start off with a massive gap down in today's session before the dip was bought. And so we're definitely setting up for an interesting next week with some big data points coming. Jobs report, Nvidia earnings. Treasury ramping back up their operations after the government's reopened. Could be a bit of a make or break week coming up for us. But it's not just online clowns posting fear, it's also the mainstream media, the economists. How markets could topple the economy with a skier headfirst in the snow and his skis depicted as red arrows going down. Typically, when big magazine covers make bold claim, it's usually a great contrarian indicator. And I agree with Tom Lee, the bears are getting bold, could be a sign selling pressure is close to ending. And we actually saw yesterday the largest amount of volume and NYSE stocks that were going down, hitting an all-time record. And again, that's a sign that selling pressure could be exhausted, because looking back in history, the market performs very well, even in the short term, 2-3 months, and especially a year out. Average gain of 24.5%, that is huge, more than double the average yearly gain. And so what has caused this sell-off is a repricing of a December interest rate cut. However, I think the jury's still very much out on that. We haven't even seen all the data that's going to play into that yet. The market's been in the dark for 43 days. With the US government shutdown, we are going to get the jobs report this Thursday. CPI actually coming out the same day the Fed meets on the 10th of December. But looking at current data for inflation, doesn't look all that bad at all. But Fed fund futures are definitely not so sure whether we will get a rate cut next month, but the path is still down into next year, which I think is very much going to happen considering we're getting a new Fed chair come May. Jay Powell hasn't already cut rates by then. You can almost bet your bottom dollar the new Fed chair will open the floodgate. And so that uncertainty of economic data, the path of interest rate, has been upsetting risk-sensitive names, which had been performing pretty well this year. And as usual, that attracts a bit of froth, bit of leverage. And so profit taking can easily turn into a sharp correction. It kind of feeds onto itself. And that's why I think we're seeing a bit of a pullback in crypto. Interesting to note that Strategy, the largest Bitcoin treasury company, is now worth less than its Bitcoin on its balance sheet, for which it usually trades at a premium, since it has the ability to issue equity and debt. And Michael Saylor did post a meme today, not even hiding the fact that he has a lifeboat when the rest of the crypto market and his fans and followers do not, as he regularly sells MicroStrategy shares, advising everybody to hold, which he may actually be right, because I do think crypto is oversold as well. Probably got the most bullish fundamental backdrop we've ever seen in its entire history, coupled with prices being technically oversold and the crypto fear and greed index being at some of its lowest levels, typically associated with market bottoms. And let's not also forget the McRib was just reintroduced at McDonald's. Looking back in history, 100% of the time, Bitcoin goes on to have a multi-month rally after the McRib is reintroduced onto the menu. However, there is one big risk hanging over the economy and markets. It's the big divergence with the stock market, crypto, crypto and the jobs market, which typically correlate with one another, but that divergence actually kicked off when GPT was released. The jobs market's been weakening for a few years, as now over half of all consumer spending is done by the top 10% of consumers. But that other half of consumer spending could still cause issues, not to mention a change of governments, just like what we saw in New York, potential rise of socialism. If a lot of people are being left out of the capital markets, we could see more and more socialist-style leaders rise to power. And so we're going to get a good look at that come this Thursday with the September jobs report to be released, highly anticipated, which if Goldman Sachs is right, may actually show a contraction, jobs market getting smaller. But does that really matter when corporate profits are still growing and more companies are using AI and soon to be robots to replace human workers? So that'll be interesting to see how the market reacts to this data release on Thursday, if it does come in soft, which may actually be a good thing because it could mean the Fed is more likely to cut rate in an attempt to try and help the labor market, which may actually turn out to be more of a benefit for stocks anyway. And so with the government reopening, that's actually setting up for a major liquidity boost for markets. The Treasury General Account, basically the government's main checking account, starts spending again now that operations have resumed, and that money flows straight back into the economy, along with the Fed ending quantitative tightening, which stops liquidity being drained and eventually adds more back in. And so more liquidity usually weakens the dollar and supports risk assets like stock. Regulators will also step in with short-term liquidity tools to avoid a year-end funding squeeze, keeping the system flush with cash. Also going to see more deregulation with banks next year. Leverage rules being relaxed, giving banks more room to buy bonds and expand their balance sheets, all setting up for a liquidity bazooka. Same deal in China and Europe, also ramping up stimulus. Global liquidity is on the rise, along with fiscal spending as we approach the midterms. So I think all of that is very bullish for crypto, typically correlates with the rise in liquidity. And remember, we're pretty much guaranteed to get lower rates come May next year, which I think they'll eventually get the overnight US fund rate down to 2.5%. And the cause of the biggest sell-off this year back in April, global trade war, potential massive surge in inflation, has not materialized. We've only got less than 6 weeks left in the year. Pretty safe to say mainstream media and experts were wrong. As once again, we get another deal, US and Switzerland, agreeing to lower tariffs on each other. And all of these deals have been more beneficial for the states, seeking to rebalance the scale. Yet it's actually American stocks that have underperformed this year, along with the US dollar, as a lot of big investors are simply not buying this story. And we just heard the admin cut tariffs on a bunch of consumer goods, and I expect to see more measures in order to help lower and middle income consumers. Big time fiscal spending, I think, which has been returning back to a monthly surplus, has the room to do. And so with that, we've seen a pullback in the most recent quarter of CEOs talking about tariffs. So I think we've well and truly seen peak fears to do with tariffs and trade deals, and that's kind of been pushed into the rearview mirror now. And so apart from the jobs data and the Treasury ramping back up, we've also got the biggest stock in the market reporting earnings after Wednesday close, Nvidia. More important than their actual results will be their guidance, which I do think will remain strong. All the indications are there, and I think we've kind of seen a broadening of AI's demand and use case with still low levels of saturation. We've actually seen Jensen Huang talk about the need for the US electricity grid to be upgraded and capacity for more energy to be added. Worried the layer one of the whole AI boom is not big enough, so it's actually energy that's the bottleneck. So I expect to see more government investments in energy-related names. And I agree with Tom Lee again. If the market has to, it will throw a tantrum, force the Fed to cut. But if jobs data comes in weak, it may not need to. Stock market may actually like that. And according to Dan Ives of Wedbush Securities, he views this sell-off as a short-lived mini panic moment for tech stock, as he believes we'll have a major rally into the rest of the year, as investors look to play out the AI revolution, and the second, third, and fourth derivatives are now playing out across consumer and enterprise names. Firmly bullish. And this chart's a little blurry, but it's interesting to note institutional investors have started buying the dip for the first time in 6 years, joining retail investors, which up until about a month ago had been big dip buys this year. And so this sharp sell-off has been more of a washout of retail trading, with big money looking to actually step in and scoop up shares from them. And so let's take a look at some of the latest moves from Billionaire hedge fund managers. As we're now 45 days into the new quarter, that's the deadline for them to report on their moves from the previous quarter, their Form 13Fs. Interesting to note, Stanley Druckenmiller recently opened a new position in Alphabet Google, and I was actually a little surprised to see Warren Buffett's Berkshire Hathaway did the same thing, just hitting the news wires as I speak. Not normally one to invest in tech stocks. He's held on to Apple for a few years. That was his exposure to tech, which he's actually been trimming, as we can see in the activity scorecard for Q3. Reduced Apple by almost 15%, and the only new buy was Google Alphabet, which he started off as the 10th largest position in his stock portfolio. And so he started accumulating in the third quarter, July, August, and September, as the stock has been steadily climbing. My regular daily viewers will know I was banging the drum about Alphabet, Google back in May and June on these dips when I was buying more shares for my long-term portfolio. The market was significantly under-recognizing their AI leadership, the high value of all their business units, not just search, email, cloud, video, robo-taxis. We've got stakes in Anthropic, SpaceX, and their huge growth in their chatbot Gemini, catching up to GPT, along with the biggest monetization potential, just as I repeatedly said back in May and June, and the stock has since almost doubled. Now with the market cap 3.3 trillion, I think it could very well catch up and overtake Microsoft and Apple, and who knows, even give Nvidia a run for its money next year. And so it's a very good sign to see the world's best stock investor, Warren Buffett, also get in. Like I said, potentially one of his last big moves of his career. Also interesting to see the Bill and Melinda Gates Foundation Trust sold a significant amount of their Microsoft holdings, in fact reducing it by almost 65%. This is the guy that founded Microsoft. Still his fourth largest holding, but now at only 13% of their portfolio. They actually own more Canadian National Railway and Waste Management, still their largest position, and Berkshire Hathaway. Here's a look at another notable hedge fund investor, David Einhorn, adding some consumer exposure with United Parks and Resorts, Peloton, and Victoria's Secret, with his largest position in home builder Green Brick Partners. Just looking at Bill Ackman's portfolio, didn't do any buying. In fact, he just reduced a little bit of some of his positions. Alphabet, Restaurant Brands, Brookfield, and Uber. With Uber still his largest position at 20%, not too far ahead of Alphabet Google when you combine non-voting shares as well. Here's a look at notable value investor Seth Klarman's portfolio and his move Q3, buying Union Pacific, Genuine Part, Americold, Realty Trust, with his largest position being in Restaurant Brands, number 2 coming in Alphabet Google again. And here's a look at David Tepper, another top performing hedge fund manager, and his moves in Q3, getting back into Chinese security with the larger cap and internet Chinese ETFs, and the Google equivalent in China, Baidu, as China blocks Google and other American big tech companies from operating there, even though they're allowed to operate in the American market. And there's a look at David Tepper's top holdings. Alibaba actually, Amazon's still up there, along with Nvidia, Alphabet, Google, Meta, and Microsoft, and Uber. Still betting on American big tech. And finally looking at Charlie Munger's protege, Manish Prabhai, adding one position to his portfolio in Q3, shipping company Transocean. And Manish, similar to Charlie Munger, runs a concentrated portfolio focused on deep value. His largest position still in Warrior Met Coal and another coal stock, AMR. And just wrapping it up, looking at some market internals, fixed term structure, still in contango, with the VIX finishing the week just below 20 after briefly hitting 23 this morning. It was a little fear to start off the day. Yields are still stable, 2-year at 360. Gold's had a bit of a pullback ever since we reached that fever buying pitch about a month ago. People queuing up at gold dealers around the world, and a bit of a pullback in some of the hottest sectors out there like uranium, which have had a good amount of momentum this year. But like I said, we are seeing some signs of the dips being bought, and market pricing for inflation expectation is still quite low. And there's a look at the Russell 2000. It was buying right off the open as we started at a technically oversold level this morning. So the key events for next week will be the jobs report on Thursday, Nvidia earnings Wednesday after close. Those two events could get the markets moving. And if we do see a repricing of an interest rate cut next month, we could see a good bounce back in crypto and other high beta names as well, which have been very much deeply oversold these past few weeks. Because remember, liquidity is on the rise. Not only the Federal Reserve, the Treasury, and the federal government is all set to rise over the coming quarters. Barring any unforeseen major events, that's all bullish for the stock market. As always, it's just my analysis and opinion. You're welcome to share yours with a comment below this video. Otherwise, have yourself a relaxing weekend, and I'll see you back here again come Monday night. Cheers.